This is the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubergen. Glad you decided to tune in today. Hey, it is the month of August, which means I have a brand new special report for you. The August 2023 special report is titled Cash Strategies. One of the first things we are all rightfully taught is that we all need cash for a rainy day because life happens, and we need to be prepared. And in this month's special report, we'll look at specific cash management strategies. To get your report, all you need to do is visit the website, requestyourreport.com. The website, again, is requestyourreport.com. And when you go to the website, requestyourreport.com, and request your August 2023 special report, I will send it to you along with a copy of my best-selling book, Revenue Sourcing. I'll also include a copy of the Little Black Book on Social Security Maximization. So a whole box of resources being offered absolutely free this month. All you need to do, again, to get all that information is visit the website, requestyourreport.com. Let me start this week's program by asking you a simple question. How many of you listening to the program are in agreement that many U.S. consumers are strapped? I think the evidence I'm going to share with you in this particular segment points to the fact that the United States, despite what the Fed chair, Jerome Powell, recently said, I believe that the economy is heading for a recession for largely that reason. The U.S. economy, as many of you know, is dependent on consumer spending. The U.S. economy is more than 70% dependent on consumer spending, and when the consumer can't spend, the economy suffers. It really is that simple. We do not have a manufacturing economy for the most part. We have a consumer spending-driven economy. We have a consumption economy. And I've been making the case for quite a long time now here on the program that the U.S. consumer is stretched to the point that the economy is being affected, and very soon, noticeably affected. Now, just a moment ago, I mentioned what the Fed chair, Jerome Powell, said recently. He noted that the Fed is no longer forecasting a recession. He did this at the same time as the Fed increased interest rates yet again, ostensibly to fight inflation. But rather than calling it a recession, Mr. Powell says they are now forecasting a noticeable slowdown, whatever that means. Bottom line is, whatever you call it, consumers are suffering, and I believe a recession is inevitable. Now, the first bit of data I'd like to provide you with on today's program is that after adjusting for inflation and taxes, the income of U.S. consumers has fallen more than 9% since April of 2020. So if you're listening to this program today, you have 9% less in real income than you had just over 3 years ago. Now that is extremely noteworthy, to say the least. Michael Snyder, in an op-ed that he recently posted, said this: on the inflation issue, household income adjusted for inflation and taxes is running some 9.1% below where it was in April of 2020. So how are consumers making ends meet? I should say, how are many consumers making ends meet? The answer is that, to some extent, they're turning to their credit cards. They're taking on debt. This is very apparent when you take a look at the statistics as far as consumer credit card debt. Consumer credit card debt at this point is now over $1 trillion for the first time ever. This is from a CNBC article published on August 8th. This article reported that total credit card indebtedness increased by $45 billion in the April to June period. That was a rise of more than 4%. And now credit card debt stands collectively at over $1 trillion for the first time ever. And that's according to the New York Federal Reserve. Now, along with that, it's not surprising that delinquency rates are going up on credit cards. The Fed's measure of credit card debt 30 or more days late climbed from 6.5% in the first quarter of this year to 7.2% in the second quarter of this year. That's more than a 10% increase in credit card delinquency rates, and that's the highest rate since the first quarter of 2012. So credit card delinquencies are now higher than at any time in the last 11 years. Now, interestingly, it's not just credit card debt that's rising. Many American consumers seem to be turning to any kind of debt they can take on to help make ends meet. Total household debt edged higher in that April to June quarter by about $16 billion. Total household debt now stands at more than $17 trillion. That's also an all-time record. Now, to add to the pain, credit card interest rates are now extremely high. Credit card interest rates now, according to Snyder's piece, now average more than 20%, and he cites Bankrate as a source. Now, another sign that consumers are stressed, and another sign that I believe we are headed for an economic slowdown in this consumer spending dependent economy, is that when you look at how many emergency withdrawals have been taken from 401k accounts, it's alarming. Emergency withdrawals are up. I should say emergency withdrawals from 401k plans are now up 35% year over year. This is from Mr. Snyder's article as well. More Americans are tapping their 401k accounts because of financial distress. He cites Bank of America data. The number of people who made a hardship withdrawal during the second quarter surged from the first 3 months of the year to 15,950. That's an increase of 36% from the second quarter of 2022, just a year ago. So here we have withdrawals from retirement accounts surging, up 36% year over year. We have credit card balances now over $1 trillion for the very first time. Household debt now stands at more than $17 trillion for the very first time. And we have home buyers, particularly first-time home buyers, that are now being priced out of the market. Just this past week, the average interest rate on a home mortgage surged to 8%. And consumers that can't afford a house at 8% interest rates with already high real estate prices are also finding they're not getting much of a reprieve when it comes to renting for a while. Rents are also increasing rapidly. Average rent-to-income ratio has now exceeded 30%. Now think about what this means for a minute. That means the average rent that a person pays is more than 30% of their income. I want to give you a quote from Fox Business here. The nationwide average rent-to-income ratio declined slightly in the first half of the year, declining to 30.2% from a high of 30.8% last year. So for the last year, the rent-to-income ratio has been between 30 and 31%, and although there was a recent decline, that decline is very nominal. So we have a median income renter in the United States now paying more than 30% of their income for an average priced apartment. This is not to get a luxury apartment. This is not a penthouse suite. This is average. Now, historically speaking, renters are considered to be burdened if rent consumes 30% or more of their gross or pre-tax income. Lou Chen, an economist at Moody's Analytics, specializing in real estate, said this, quote, "What that means is, by and large, the U.S. is still rent burdened because we are officially above that 30% rent burden threshold. We're seeing levels of relief, but also combined with the inflationary and pressure elsewhere, so we're still spending a little higher on the necessities, on food and energy, along with other necessary spending." So I believe we are going to see a recession. I believe that will also mean that stocks decline. In the fourth segment of today's program, I'm going to give you the forecast of a very, very reputable forecaster, Mr. Michael Burry. But as I close this segment, let me remind you that we do have available for you the August 2023 special report, Cash Strategies. Visit requestyourreport.com, and I'll send you the report along with all the bonus information I mentioned at the beginning of the segment. I'll be back after these words with my special guest, Dr. A. Gary Schilling.
Welcome back to RLA Radio. I'm your host, Dennis Tubergen. Joining me once again on today's program is Dr. A. Gary Schilling. Longtime listeners will recognize Gary as a longtime Forbes columnist. He is the founder and president of A. Gary Schilling and Company. He is also the publisher of the Insight newsletter, which is a monthly newsletter that is more like a magazine filled with a lot of terrific information. If you'd like to learn more about his newsletter or get a free copy, you can go to 888-346-7444, which is his office phone, 888-346-7444, and Gary would be glad to share with you a complimentary copy of the newsletter. And Gary, welcome back to the program.
Glad to be back with you, Dennis, as usual.
Well, Gary, let's just jump in here. Give our listeners your assessment as to the health of the U.S. economy.
Well, that's a very good question, because you can read that two ways. If you look at what a lot of people are concentrating on, they're looking at employment, which is weakening, but it hasn't fallen apart. They're looking at stocks, which seem to just keep going up regardless of what happens. They're looking at enthusiasm. They're looking at investors that think we're in for a soft landing, that the recession is simply a thing of the past or it never happened. And then you can turn it around and look at the normal leading indicators, the inverted yield curve leading indicators, and of course you look at what the Federal Reserve is doing, and what the Fed is doing now is in the past has always led to a recession. And so you really have a very interesting dichotomy here. And of course what's fascinating about this is that a lot of investors simply think that the Fed doesn't matter. Now, I'll bet on the Fed any day, and I think the Fed under Chairman Powell is particularly zealous to bring inflation down to their 2% target. It's come down, but it's about 3%, and in the service area, which they're particularly concerned at, it's running about 4%. So you've really got a battle of investors versus the Fed, and say I'll bet on the Fed.
So, Gary, let's just to take that a step further. Where do you think the Fed is in the tightening process here? And did you see more rate increases this year, or do you think we've seen the top here?
I think we've got more rate increases. The Fed would obviously like to back off. They don't go out to deliberately precipitate a recession. But their concern is inflation, and they worry that if they back off prematurely, then, as we've seen in the past, the 1970s were certainly a case in point, that then all hell breaks loose, and then they've really got to kill things to convince investors that they have teeth. So I think they really want to make sure that they kill inflation. So I don't think they're through raising rates. And of course, as long as investors are pushing up, particularly stocks, the Fed, I think, is determined to really say no. We're going to deal with this, and until you believe that we are, you're really just going to have to suffer the consequences.
So, Gary, when you take a look at just the general health of the economy, I made a note here that credit card debt now for consumers has topped $1 trillion for the first time, and the U.S. economy, as we've discussed in the past, is very dependent upon consumer spending. Isn't the American consumer at this point pretty strapped? And what's your take there?
It's a very interesting dichotomy, Dennis, because if you look at all the extra saving that was built up, because of the stimulus back in the COVID years. You know, there was a tremendous amount of money that was pumped into the economy by the administration and Congress, and also by the Federal Reserve, and that really pushed up savings. And there's still a fair amount of that around. But at the same time, as you point out, we're seeing credit card debt, $1 trillion. We're seeing people who are borrowing because they really have no choice, and with credit card rates around 20%, obviously they're pretty desperate. So I think you've got a real dichotomy that, yes, there's still a lot of cash out there, but it's not in the hands of everybody. It's not evenly distributed, and that's what makes things difficult to analyze. But I think that the big run-up in credit card debt is telling us that a lot of people are really strapped. And, of course, we've got an event coming up here in October when students have to start repaying debt, and that, as you know, that was a result of the Supreme Court decision, which really negated what the administration wanted to do. So you've got a situation there where you've already, you got a lot of people with serious debt, and it's going to get even more severe this fall.
Well, if you're just tuning in, I'm chatting today with Dr. A. Gary Shilling. His website is agaryshilling.com. He is also the publisher of the Insight newsletter, and you can get a free copy by calling his office, 888-346-7444. And Gary, how impactful the student loan moratorium expiring, to use those terms, how impactful is that going to be on the overall economy in your view?
Well, it makes a great deal of difference. A lot of the debt is run up by graduate students, by people who have good jobs, who do have the ability to service the debt. But there are a lot of people, and we don't really have a good handle on the numbers as to who's in what camp. But there are obviously a lot of people out there who do not have the resources to service that debt, and what it means is that they're going to have to cut back on their spending tremendously, and as you probably know, federal student debt is not subject to bankruptcy. You can't go bankrupt to get rid of federal student debt. A lot of debt you can. Credit cards and so on, but you can't do that. It's not legal with federally funded student debt, which is the vast majority of it. So you've got a lot of people there who are really stressed.
Well, and Gary, along those same lines, I recently read that adjusting for inflation and taxes, the income of U.S. consumers since April of 2020, since the COVID years, as you say, has fallen more than 9%. Do you agree with that? And do you think that trend is going to reverse?
Well, we have had lately. You had a long period there when wage increases were simply not keeping up with inflation. Now, what's happened in the last 4 or 5 months is that inflation has come down, and so even though the rate of increase in wages has not picked up, still it means that for the last 4 or 5 months that people have had actually positive real wages, real meaning inflation adjusted. But that does not mean that they're back in high clover. It means that they're not racking up a lot more problems than they had before. But there still are a lot of difficulties from the past.
Well, Gary, let's shift gears a minute and talk about stocks. Before we started to record this interview, we chatted a bit, and I think I made the comment that stocks certainly aren't reacting the way one might expect when you look at just the fundamental data. Give us your assessment as to the major U.S. stock market indices. And I know when we talked before, I think it's been about 5 months or so, you were not really bullish on stocks. So what's your forecast, and have you changed your mind?
No, I think stocks are still very vulnerable. They have had a big run. I don't think it is supported by what you call the fundamentals, by earnings growth, by economic expansion, by income. But the way I put this, and I've been saying this for about 30 years, markets can remain irrational a lot longer than I can remain solvent. And you simply have to, my approach to this is you simply got to be on the sidelines. You just say, hey, I just don't want to be involved. I don't believe it's valid. I think we're going to see some very big corrections. Stocks last year, early in the year, they declined about 20%. I'm looking at the S&P 500 index. Then you had a rally. It got back to within about 5 or 10% of its all-time peak. Lately, it's been a little sloppy. But I think we could have from here a 30% decline in the S&P 500, and that would be in keeping with my earlier forecast that the peak-to-trough decline would probably run about 40%. The first half of that last year was really the Fed tightening and pushing up interest rates. The second half, which I think we're getting into now, is the effects of weak corporate profits, weak corporate sales, and that means that stocks in relative to earnings, not only reported earnings but future earnings, are very expensive.
Well, I am chatting today with Dr. A. Gary Shilling. He is the founder and president of A. Gary Shilling Company. You can learn more about his work at agaryshilling.com. Gary also publishes Insight Newsletter, which is a terrific publication. He would be glad to share a complimentary copy with our listeners. To get your free copy, give his office a call at 888-346-7444. The number again is 888-346-7444. And I will return after these words and continue my conversation with Dr. A. Gary Shilling. I'm Dennis Tubergen. You're listening to RLA Radio. I have the pleasure of chatting once again today with returning guest Dr. A. Gary Shilling. Gary is the publisher of Insight Newsletter, which is really more of a magazine every month that provides you current economic data and Gary's forecasts. He has been uncannily accurate through the years, and he's happy to share a free copy of that newsletter with you. If you'd like to get it, call the office, 888-346-7444. That is Gary's office at 888-346-7444. So, Gary, as we concluded the last segment, you were forecasting that perhaps we could see a decline of up to another 30% here in the S&P 500. When you look at certain sectors of the market, we've certainly seen, for example, oil prices now start to rebound. Is there any sectors of the S&P that you might be bullish on?
Not really, Dennis. Matter of fact, one of the things that we've looked at and reported on in our monthly newsletter many times over the years is the 10 components of the S&P 500 index, and they publish 10 components: consumer staples, consumer discretionary spending, energy. You go down the list. There are 10 major sectors, and if you look at past bear markets associated with recessions, and I think that's what we're looking at here, you've never had any of those that actually rose. Now, some of them have done better than others, and the ones that you would expect, the so-called defensive stocks, utilities, consumer staples tend to hold up better, but they have never actually risen. In other words, you may lose less money if you're in these defensive stocks, but the odds of making money, at least if you buy the broad segments, it just has not happened historically.
So, Gary, I want to go back to you mentioned a stock decline associated with a recession. In the first segment, you talked about the inverted yield curve. Has there ever been an inverted yield curve that did not lead to a recession?
No, not really. I mean, you've had no, I don't think you have. Not in the post World War II era. Every time you've had an inverted yield curve, you've gotten a recession. Now the timing is can vary all over the lot. It can be anywhere from a month or two to maybe 6 months or a year later. But when you get an inverted yield curve, historically, you've always had a recession.
So, assuming we are going to have a recession here, how deep do you think it might be?
Well, I don't see any reason why it's going to be deeper than normal. And the average recession in the post-World War II period takes real inflation-adjusted GDP down by about 3%. 3% doesn't sound like a lot, but when you're in an economy which is geared to growth, and of course 3% in the total means that some sectors are a lot weaker. Housing, we've already seen, very sensitive to interest rates, and that's declined a lot more than 3%. And some of these interest rate sensitive areas, consumer durable goods, things that are postponable, they tend to do a lot worse. But on average, the economy peak to trough declines about 3%, and I don't see any reason why it would be more than that. Now, if you go back to the Great Recession, the one that we had, a decade ago, there you had 4.5% real GDP decline, peak to trough. That was a very, very serious one, and that was led by the collapse in subprime mortgages. You had huge speculation, a lot of people involved, and you've had speculation this time. It's been mainly in the crypto area and others, but it was never as widespread or as severe as it was in housing. Back in the days when people could borrow on houses and literally put nothing down and were assured they never have to put a nickel in because the house would appreciate so much they could refinance and take money out before the first mortgage payment was due. I mean, it was a wonderful free lunch era. Never land. The tooth fairy had arrived. We don't have anything that severe right now, so I don't think we're going to have anything more than a normal recession. But we have had a lot of speculation. We've seen some of it come unglued. You're well aware that early this year we had a bank, Silicon Valley Bank, was a standout where they really got nailed because they had this huge inflow of deposits. All these people from these Silicon Valley deals, these venture capital deals, and they put it in the deposits. They put in Treasury obligations, nice, safe, and sound treasuries. Well, what happened was when the Fed raised interest rates, the value of those treasuries declined. Now, they don't have to mark them to market normally, but deposits started to flow out, so they had to mark them to market as they sold those treasuries, and that was the demise of Silicon Valley Bank and a couple of others. So, you really did have some imbalances there, and you never know what's going to come out of the woodwork. But I can't see anything right now that's going to rival what we saw in terms of the subprime mortgage collapse in the 10 years ago.
Well, Gary, you mentioned Silicon Valley Bank, and then of course there was Signature Bank and First Republic. Recently, we have Kansas Heartland Tri-State, a regional bank closed by FDIC. Do you think these banking issues are going to continue? And if so, to what extent do you think it'll kind of be a canary in a coal mine, if you will, that we are headed for a recession?
Yeah, it is, Dennis. I mean, it's not a run on the banks in the 1930 sense, because the Fed, the FDIC, the other regulators have basically bailed them out. They in other words, they guaranteed all the deposits in those banks, Silicon Valley Bank, Signature Bank, etc. But that doesn't mean you don't get the effects of that. And what are the effects? The effects are that the banks are very, very scared. They don't want to lend. And, of course, depositors, even though their deposits, I think, are safe, I think they'll get bailed out regardless, they have pulled out money from banks, and they put it into money market funds, into Treasury securities. So you've had a decline in bank assets, the deposits, and you've had a bank decline in their liabilities, loans. They don't want to loan money. They're scared. So you've really had a very similar effect to the run on the bank. I call it a slow motion run on the banks, which is still much there. And as you point out, this continues. So you do have these effects.
Gary, you mentioned housing, and I'd love to get your forecast on housing, but I wanted to get your take on this. It seems that, with these artificially low interest rates, and you had a lot of people refinance, and there's a lot of people out there that have 30-year mortgages at even sub 3%, but certainly low 3%. Aren't those people kind of in housing jail? And didn't the Fed maybe inadvertently kind of shrink the housing market? And this is as housing slows, this is a problem of the Fed's making?
Well, in a sense, it is, because the Fed raised interest rates, and now they did after the Great Recession, 2008 financial crisis. They did something they've never done before. They favored housing. They did that by buying mortgage-backed securities. Normally, they just buy treasuries to support the economy and let the chips fall where they may. But that was the first time ever, as far as I know, where they supported a specific sector, housing, by buying mortgage-backed securities. But they have since then been selling them off, and I don't think that they have any desire to step back in and support the housing market. Hey, if the world fell apart, you never know what they're going to do. But I think unless you got very, very severe situations, and it would take something like the collapse in the subprime mortgages that we have, and I don't see anything on the horizon that's likely to match that. So I rather suspect that we won't see the Fed doing much to bail out housing. And as you point out, what's happening, you got a lot of people who have very low interest rate mortgages that they got during the post financial crisis years, and that means that they don't want to sell their houses and buy other houses. You've had very low turnover in existing housing, because then they'd have to take out another mortgage at a much higher rate. So you've had very little turnover in existing housing. It means that the strength in housing has been in new housing, and builders have been active there, but still, new housing is only 15 or 20% of the total. Normally, the rest is trading in existing housing. So the overall effect has been a fairly subdued housing sector.
So what is your forecast for housing moving ahead, Gary?
I don't think it's going to be exuberant. I don't think it's going to collapse. I think it's going to be a fairly mundane sector from here on. I mean, there's always the argument that we don't have enough housing and so on and so forth. But that hey, there's never enough. There's never enough Mercedes-Benz around. I wouldn't mind having one, or Rolls-Royce. I mean, that's not a valid question. I mean, sure, if things were cheap enough, what they say, if wishes were horses, beggars would ride. It was a very old saying, and I don't think it's not a logical statement to say that there's a shortage of housing. Yeah, there's a shortage of housing at what people want to pay, but we're really the most overhoused country in the world. When you look at the square footage of housing per occupant, we're very we're very sparse. You got a lot of rooms relative to the number of people, and what happens? You get rentals, which absorb the difference, and people and people simply don't form families. I mean, to form a household, you have to move into a separate dwelling unit. That's the way it's defined. A household is one or more people occupying a separate dwelling unit. That's the government's definition. Well, if people don't feel they can afford a house, they just don't move in together, and of course, a lot of people are operating without the benefit of clergy these days. So I don't know that that's really bothering them a great deal. Very different than when I was young and you were younger, but that seems to be the style.
Yeah, well, we're going to have to leave it there. My guest today has been Dr. A. Gary Shilling. The website is agaryshilling.com. You can get a free copy of Gary's Insight newsletter. I'd encourage you to do that. Give his office a call at 888-346-7444 and just request a copy of the Insight newsletter. Gary, always a pleasure to catch up with you. Appreciate the update. Love to have you back down the road. Thank you for joining us.
Look forward to the next encounter, Dennis. Thanks a lot.
We will return after these words.
You are listening to RLA Radio. I'm your host, Dennis Tubergen. Glad you're listening in today. Hey, if you've not yet requested the special report for the month of August, I'd encourage you to do so. You can get your copy of the report by visiting requestyourreport.com. The August 2023 special report is titled Cash Strategies, and the report outlines several cash strategies for today's economic environment. When you request the report, I'll also send you a copy of my best-selling revenue sourcing book that contains a retirement planning strategy for today's economy. And I'll also include a copy of the book, The Little Black Book on Social Security Maximization. You'll get all that information by simply visiting requestyourreport.com and letting me know where you would like me to mail that information. Again, the website, requestyourreport.com. Undoubtedly, many of you listening to the program today have seen the movie The Big Short. If you haven't seen the movie, I would encourage you to check it out. It is entertaining, and there's also some educational content in there. But the bottom line, the overview of the movie is that Michael Burry, who you might describe as a bit of an eccentric hedge fund manager, in 2005, Mr. Burry started to do some research on the housing market. And because of all the subprime loans that existed, he concluded that the market was extremely unstable. And he anticipated that the housing market would collapse. So Mr. Burry used a vehicle in the movie called a credit default swap, which is basically a bet, an insurance policy, if you will, that he paid premiums on that allowed him to profit if the housing market declined. Now, his long-term bet on the housing market declining was more than $1 billion. And every month, Mr. Burry, anticipating this housing collapse, would pay a premium. And his main client in the fund accused him of wasting capital and sued him because Mr. Burry limited withdrawals to preserve capital to be able to pay these premiums. Well, the housing market did eventually collapse, and Mr. Burry's fund made about a 500% profit, and the client that sued him walked away with almost a cool $500 million. So Mr. Burry has a pretty good track record when it comes to predicting where markets might go. Now, Market Insider recently reported that Mr. Burry has now placed bearish bets against the S&P 500 and the NASDAQ 100. So he's betting on the market to decline. And certainly there are those out there that say Mr. Burry is going to be wrong. Mr. Burry has it wrong this time. There's always detractors. However, given his track record, one would have to give some credibility to the fact that Mr. Burry now has bet $1.6 billion on the market the stock market rather, collapsing. Now, he made his bet on the housing market collapsing back around 2008, and now he's betting on the stock market collapsing. And you have to take a look at some of the conditions that exist today, and there are certainly some parallels to today's market to what existed in 2008. So, for example, commercial real estate is now falling in price at a very rapid pace. The residential housing market is quickly drying up. We have mortgage rates, as I indicated, now at almost 8%, which means that the payment on an average home has gone up about $1,000 a month in a little bit more than the last year. So how many people are going to be able to afford more than $1,000 a month for the same home? At the same time, as I pointed out in the first segment, we have rent-to-income ratios now exceeding 30%. So you certainly have the consumer now that is renting, that is rent burdened. So bottom line is we have this housing market, whether you're buying or renting, housing has become extremely unaffordable. At the same time, we have inflation that is continuing to whittle away at the purchasing power of the average American. As I pointed out in the first segment, since April of 2020, the average American has lost more than 9% of real income. Now, Redfin recently, a real estate analysis company, recently reported that the percentage of teachers that can afford to buy a home close to the school that they work, where they work, has fallen to 12%. So only 12% of teachers can afford to buy a home near the school at which they work. Now, that's down from 17% last summer and 30% in 2019. That is a rapid decline, and that particular statistic is indicative as to how strapped U.S. consumers actually are. It's for these reasons that I believe we will see a recession, and I believe we will see stocks respond accordingly. And if you've got money in a 401k plan, if you've got money in an IRA plan, and you aspire to a comfortable, stress-free retirement, I would encourage you to get the box of resources, the box of information I'm offering during the month of August. It's the Cash Strategies Report. It is the Revenue Sourcing book, and it is the Little Black Book on Social Security Maximization. I'll send it all to you by simply visiting the website, requestyourreport.com. The website, again, is requestyourreport.com. That's all the time I have for this week. Hope you got something you can use, and I'll be back again next week.